Welcome back to BizIntel, your weekly news briefing taking a deep dive into the shifts quietly reshaping the global economy. Amazon is now tracking whether its employees use AI, while Meta and Accenture have made it a criterion for promotion. This begs the question, are we using AI because it genuinely drives efficiency, or simply because we won't get promoted otherwise? At Amazon, an internal system called Clarity is actively monitoring employees' AI usage, logging specific tools ranging from coding assistants to operational optimization systems. Within the Supply Chain Optimization Technologies division, promotion evaluations now require specific descriptions of how AI was utilized to improve efficiency or accomplish more with less. These claims must be backed by measurable, real-world results. Meta has integrated AI usage into its engineer performance reviews. Similarly, Accenture demands regular application of AI as a prerequisite for management promotions. AI is no longer just a support tool. It is rapidly becoming an operational standard. Parallel to these internal corporate shifts, market figures continue to soar with massive funding rounds and large-scale chip and data center deals. Massive stock market volatility is repricing software, infrastructure, and future earnings. This week's episode will cover four main segments: AI, infrastructure and chips, enterprise and software, markets and stocks, and notable startup, IPO, and M&A deals. AI from nice to have to must have. AI infrastructure and chips, the gigawatt game. If there is one defining metric for the past week, it is the gigawatt. From chip deals and data center contracts to power cost projections, every figure is being calculated on a scale unprecedented in the history of the tech industry. OpenAI is finalizing initial commitments for a funding round that could reach $100 billion. At a post-money valuation of roughly $830 billion, this catapults the company into the ranks of the world's most valuable enterprises, trailing only Apple, Nvidia, Microsoft, and Alphabet. SoftBank plans to invest $30 billion in multiple tranches this year. Amazon could participate with up to $50 billion, and Nvidia with around $30 billion, while Microsoft continues to inject a few billion more. An IPO could happen as early as Q4 of this year. On the business front, 2025 revenue landed at approximately $13.1 billion. Looking ahead to 2026, the revenue target is set at around $30 billion, potentially reaching $62 billion by 2027. However, the gross margin in 2025 dipped to roughly 33%, lower than the previous year, reflecting the escalating costs of running these models. Compute costs currently represent the largest chunk of the expense structure. In 2025, OpenAI spent over $8 billion on model operations, with roughly $4.5 billion allocated to inference, the real-time processing of user requests. This expenditure is projected to surge to about $14 billion in 2026 and $26 billion in 2027. Concurrently, model training costs continue to expand from roughly $8.3 billion in 2025 to $32 billion in 2026 and $65 billion in 2027. The total budget for training and operations through 2030 is estimated at around $665 billion. Training costs alone could potentially make up nearly $440 billion of that total. At this current rate of investment, OpenAI projects a cash deficit of approximately $25 billion in 2026 and $57 billion in 2027. Project Stargate was announced at the White House earlier this year, with a projected total investment of $500 billion and a target capacity of 10 gigawatts. However, the project is no longer being deployed as a centralized alliance with an independent operational body, but rather through individual agreements with infrastructure partners. One notable contract is a 4.5 gigawatt deal with Oracle. The key departure from the traditional cloud computing model is that OpenAI has agreed to share the risks associated with data center construction cost fluctuations, an uncommon structure in standard cloud contracts where clients typically do not bear infrastructure investment risks. In Texas, another 1 gigawatt project is being rolled out under a model where SoftBank develops and owns the infrastructure, while OpenAI signs a long-term lease and controls the engineering design. This approach allows OpenAI to maintain an asset-light model on its balance sheet while securing operational control. Meta has signed an agreement to purchase AI chips from AMD equivalent to roughly 6 gigawatts of compute capacity. The deal includes warrants to acquire up to a 10% stake in AMD if specific ordering conditions are met. Previously, Meta had also secured long-term agreements with NVIDIA to guarantee GPU supply for its systems. Simultaneously, AMD is guaranteeing a $300 million loan provided by Goldman Sachs to data center startup Crusoe to purchase its AI chips, a form of direct financial support aimed at expanding its customer ecosystem. Cerebras Systems has refiled for a U.S. IPO after signing a contract to supply about 750 megawatts of compute capacity to OpenAI in a deal worth around $10 billion. The company was previously valued at roughly $23 billion following a $1 billion funding round. This return to listing plans follows concerns about its heavy reliance on the G42 customer group that were partially eased by the OpenAI contract. When capacity is measured in gigawatts, electricity becomes the central variable and the main point of friction with local communities. Amazon announced plans to invest $12 billion in data centers in Louisiana and committed to fully self-fund all associated power costs. The move comes amid growing concerns over the impact of large-scale AI projects on local consumer electricity rates. Meanwhile, Elon Musk's xAI is facing opposition in Mississippi and Tennessee as it plans to power data centers using dozens of natural gas turbines. A recent environmental hearing drew hundreds of protesters, reflecting escalating political pushback around the AI industry's energy decisions. In India, Reliance Industries announced plans to build roughly $110 billion in computing infrastructure over the next 7 years. This marks the entry of one of Asia's largest conglomerates into the global AI infrastructure race. Enterprise and software, AI enters the operating system. While AI at the infrastructure layer is measured in gigawatts and billions of dollars, at the enterprise layer it is being measured in KPIs, promotion dossiers, and software revenue. Over the past week, the line between choosing to use AI and being required to use AI continued to blur. At Amazon, the Clarity system tracks not just work hours, but specifically measures the AI adoption rate of individual teams. It logs details down to specific tools like the Kiro coding assistant. In the Scott division, promotion standards require candidates to demonstrate how AI helped them accomplish more with less, backed by measurable results. Meta has incorporated AI usage in coding into its engineer evaluation and bonus systems. Similarly, Accenture requires regular application of AI as part of the criteria for promotion to senior management roles. In many cases, using AI is no longer optional. It is directly tied to recognized competence within the organization. COBOL, developed in 1959, still processes around 80% of in-person credit card transactions globally. It represents one of the oldest and hardest to replace software infrastructure layers in the financial industry, with hundreds of billions of lines of COBOL code running across banking and insurance systems. Last week, Anthropic announced that its Claude Code tool can automatically translate legacy COBOL systems into modern programming languages. This news immediately sent IBM stock tumbling 13%, driven by fears that AI could erode demand for traditional software modernization services. In response, IBM noted its years of investment in code translation, including the 2024 launch of Watson's Code Assistant. Amazon has also entered this space with AWS Transform since 2025, and IBM is a partner of Anthropic integrating Claude into its product ecosystem. OpenAI is rapidly transforming from a consumer company into a powerhouse in the enterprise software space. Revenue from its ChatGPT enterprise tier is projected to hit around $8 billion this year across subscriptions, agents, and collaborative research programs. The AI model via API business is expected to bring in about $5 billion in 2026, rising to $10.5 billion the following year and potentially roughly $50 billion by 2030. In investor presentations, OpenAI executives indicated that future products and AI agents could potentially replace software from Salesforce, Workday, Adobe, Slack, and Atlassian. This ambition extends beyond the external application layer, targeting the core operational systems of enterprises, a domain previously dominated by traditional SaaS platforms. Beyond software, OpenAI is also developing a lineup of AI devices, including smart speakers and smart glasses. Hardware revenue is forecasted to grow from around $100 million this year to approximately $1.3 billion next year. Parallel to OpenAI, Anthropic is gearing up for a major expansion into enterprise agents. AI systems capable of automating multi-step workflows within corporate environments. Unlike consumer-facing chatbots, enterprise agents are designed to handle sequential task chains, from aggregating data and analyzing reports to triggering actions within internal systems. The push into this segment signals AI's shift from the interface layer down to core operational workflows. The relationship between OpenAI and Anthropic is therefore one of coopetition. Both are embedding themselves into enterprise ecosystems via partnerships while directly clashing in the next-generation enterprise software market. Intuit, the company behind financial software like TurboTax and QuickBooks, announced the integration of Anthropic's Claude into its platform. The agreement allows enterprise clients to build internal AI agents tailored to their specific needs. For instance, a restaurant chain could deploy an agent to analyze operational data in real time and support decision-making. This integration doesn't just add an AI feature layer, it empowers customers to customize and deploy agents directly within their existing systems. This illustrates how traditional SaaS providers are opting for a strategy of absorbing AI into their products rather than letting AI become an external replacement. As foundation models expand into the enterprise space, flexible integration capabilities could become the deciding factor in customer retention and maintaining a competitive edge. Not all software companies are being impacted in the same way. Cadence, a provider of chip design software, utilizes a workload-based pricing model rather than a per-seat model. This structure ties revenue directly to the volume of work rather than the size of the team, shielding Cadence from the risk of revenue decline if AI helps companies reduce headcount. Cadence is also developing its own AI tools to automate chip design and simulation, arguing that the increasing complexity of semiconductor design will continue to drive demand for specialized software. Consequently, Cadence's stock saw a milder decline compared to the broader market last week. Markets and stocks, the repricing. Over the past week, market reactions spanned social media platforms, fintech cloud infrastructure, and satellite internet. The common thread is that investors are no longer solely focused on the growth narrative. They are increasingly zeroing in on the quality of that growth, including profit margins and cost structures. They want to see the ability to translate expectations into actual cash flow. Reddit stock has plunged roughly 42% over the last 5 weeks. Logged-in US users remained flat at around 23 million throughout 2025. Logged-out users driven by web searches continued to grow but yielded significantly lower advertising value. Ad revenue in 2025 surged 74% to approximately $2.1 billion. Data licensing to AI companies contributed only about $140 million, despite earlier expectations. With users finding information via AI tools, the user growth narrative has become a more sensitive variable. Klarna's stock dropped 27% following its Q4 earnings release. Revenue rose 38% year over year. Yet management said faster adoption of new loan products forced early provisions for credit losses. This dented short-term profitability. The market is clearly distinguishing between top-line revenue growth and the ability to sustain profit margins. Scaling up is no longer enough to support stock prices if the profitability structure is under pressure. Oracle shares slid after details of its 4.5 gigawatt deal with OpenAI were made public. Under the contract structure, Oracle and OpenAI share the risks associated with data center construction cost fluctuations. This departs from traditional cloud structures where clients typically do not share in infrastructure investment risks. The key takeaway is that risk is no longer solely absorbed by the data center operator. It has become a shared economic component between both parties. As projects scale to the gigawatt level, construction costs and deployment timelines can be highly volatile. This contract structure directly impacts long-term profit margins. Investors worry that if future AI infrastructure projects demand similar risk-sharing terms, cloud provider profitability could shift significantly. Starlink has reached roughly 10 million global subscribers. To sustain growth ahead of the impending launch of Amazon's satellite service project Kuiper, the company slashed its U.S. service plan to around $50 per month. They also cut terminal hardware prices from $599 to $349. Revenue in 2025 came in at roughly $16 billion, falling short of the previous $19 billion forecast. This reflects the pressure of having to cut prices to defend market share amid intensifying competition. The market is monitoring the quality of each subscriber, including price points, retention costs, and the ability to sustain revenue. When price cuts become necessary to protect growth momentum, the narrative reverts to actual revenue versus initial expectations. OpenAI is currently valued at roughly 14 times its projected 2027 revenue. Meanwhile, Alphabet is trading at about 6.7 times its projected revenue for the same period. This gap reflects a stark difference in how the market prices growth. On one side is a pure-play AI company with rapid revenue expansion but massive cash burn to fund infrastructure and products. On the other is a mature tech conglomerate with stable cash flows and a diversified ecosystem but slower growth. This multiple disparity is more than a valuation story. It is a barometer of expectations. When the market pays a significantly higher multiple for a company lacking sustainable profitability, it signals faith in future scalability over present financial efficiency. Startups, IPOs, and M&A, the shifting capital flows. After a period of near absolute focus on pure play AI, this past week showed capital broadening into other business models from consumer staples to fintech and semiconductor infrastructure. As public markets tighten expectations around profit margins and cash flows, the private markets are also beginning to seek out narratives with clearer financial structures. Hungry Root, a personalized subscription-based food delivery platform, recorded approximately $700 million in revenue in 2025, up 55% year-over-year, and has already achieved profitability. Company management indicated they are considering an IPO in 2026. Hungry Root's model relies on consumer data and personalized food choices, falling into the consumer staples category rather than pure software. This makes it less directly exposed to the wave of AI disruption compared to SaaS companies. Among the companies slated for a potential 2026 IPO, Hungry Root is a rare case, combining over 50% growth with positive profitability. This contrasts sharply with many tech startups that still prioritize scaling over reaching break-even. The emergence of a consumer business with clear cash flows on the potential IPO list suggests that capital is not just chasing growth narratives, but is actively seeking more sustainable financial structures in a market undergoing risk repricing. Robinhood announced a $1 billion private investment fund under the ticker RVI, allowing 25 million retail investors on its platform to access shares of unlisted companies like Stripe, Databricks, and Ramp. Unlike traditional private investment models with long lockup periods, RVI fund certificates can be traded daily directly on the Robinhood platform. This structure aims to create higher liquidity for an asset class typically associated with multi-year holding periods. This move comes as many tech companies continue to delay IPOs and maintain high valuations in the private market. With investment opportunities in high-growth companies increasingly concentrated in the unlisted sector, structures like RV reflect a concerted effort to democratize retail investor access to assets previously dominated by institutional funds. News that Stripe is weighing a potential acquisition of PayPal is drawing massive attention in the payments industry. PayPal currently has a market capitalization of around $41 billion, while Stripe is valued at approximately $159 billion. Stripe processed about $1.9 trillion in payment volume last year. If the deal materializes, it would be one of the largest transactions in the history of digital payments. The deal would marry an API-centric payment infrastructure platform with a long-established consumer brand. The valuation disparity reflects a shift in how the market perceives value toward platforms deeply integrated into e-commerce and software ecosystems. The mere possibility of this M&A suggests the industry's competitive landscape is entering a reshaping phase. Cerebras Systems has refiled for a U.S. IPO after signing a contract to supply approximately 750 megawatts of compute capacity to OpenAI in a deal worth around $10 billion. The company was previously valued at roughly $23 billion following a $1 billion funding round and had faced concerns over reliance on the G42 customer group. Returning to listing plans amid expanding AI infrastructure demand shows that compute infrastructure providers are directly benefiting from the AI investment wave. Some software companies face questions about being disrupted by the very same technology. A chip designer accelerating its listing roadmap after securing a massive capacity contract indicates the market is prioritizing businesses positioned upstream in the AI cycle. When infrastructure becomes the bottleneck, companies selling compute capacity often enjoy a distinct advantage over software companies pressured to prove they can maintain profit margins. When AI is measured by different yardsticks. This past week revealed something clearer than any strategic declaration. AI is exposing the true economic structure of every business. Companies dependent on user growth but burdened with thin margins are under heightened scrutiny. Infrastructure projects announcing hundreds of billions of dollars are forced to explain their funding mechanics. Financial innovations like publicly traded private investment funds will have to prove they can withstand market cycles. As AI enters a deployment phase measured in gigawatts and tens of billions of dollars, the question is no longer just how good the product is, it's about who has a balance sheet strong enough, contracts airtight enough, and a revenue model resilient enough to weather escalating costs and market volatility. The AI race is thus transitioning from a competition of intelligence to a competition of capital structure. And in this race, the winner might not be the one who announces the grandest ambitions, but the one who designs an economic system capable of sustaining them.